8 times a year, a group of people sit around a table in Washington and make a decision that ripples through every mortgage, every savings account, every credit card, and every stock portfolio in America. Most people hear the headlines: Fed raises rates, Fed holds steady, Fed signals cuts, and move on without understanding what it actually means for them. By the end of this video, you will. Let's get into it. When the Fed raises rates, borrowing money gets more expensive across the board. For mortgages, this is significant. A 1% rise in rates on a $400,000 mortgage adds roughly $250 to your monthly payment. That is $3,000 a year, just from a single rate move. For credit cards, most variable rate cards are tied directly to the Fed. When rates go up, your minimum payments go up with them. Carrying a balance becomes increasingly costly. On the positive side, savings accounts start paying more. High-yield savings accounts and money market funds become genuinely attractive places to park cash. And for the stock market, higher borrowing costs squeeze company profit margins. Investors typically price this in by selling, which is why markets often dip when the Fed raises rates aggressively. When the Fed cuts rates, the picture flips. Mortgages become more affordable. Home buyers can borrow more for the same monthly payment, and existing homeowners with high-rate mortgages often rush to refinance. Credit card rates ease, making variable rate debt cheaper to carry, though the smart move is still to pay it down as fast as possible. The downside: savings rates drop. The high-yield savings account that was paying 5% might drop to 3% or lower. Cash sitting idle slowly loses its purchasing power to inflation. And the stock market, it tends to rally. Cheaper borrowing boosts company earnings, and investors bid up stocks in anticipation of stronger growth ahead. Let's make this practical. Here is how to position yourself in any rate environment. When rates are rising, if you have a variable rate mortgage or are shopping for a home, consider locking in a fixed rate before rates climb further. If you carry credit card debt, attack it aggressively. The cost is going up. And move idle cash into high-yield savings accounts or short-term CDs while the rates are good. When rates are falling, if you have a mortgage, look into refinancing. Cash in savings starts earning less, so consider putting it to work in a diversified portfolio. And historically, falling rates have been a tailwind for stocks, though never make investment decisions purely based on rate direction. For bonds, it is worth knowing, rising rates push bond prices down, and falling rates push them up. So if you hold bonds or bond funds, the rate environment matters.